Hey, what's up, everybody? It's your favorite stock whisperer back again, just like that pre-market caffeine jolt you didn't know you needed. Now, if you're looking at your screen this morning and thinking, wait, why's the Dow tanking but the Nasdaq's flexing like it hit the gym over the weekend? Don't worry, I got you. We've got a split market, a Fed that's playing coy, defense stocks going kaboom after Trump drops a 1.5 trillion mic, and oh yeah, the job market kind of cooling off like leftovers in the fridge. So buckle up, because today we're breaking down why this market is all vibes, no chill, and more importantly, how to play it smart while everyone else is chasing headlines. Let's get into it. All right, so here's the scene. The S&P dipped 0.34%. Dow dropped nearly 1%, but the Nasdaq up 0.16%. Now, what's going on here? Simple. We're seeing money rotate back into big tech and AI names, and out of financials and housing plays. It's like the market went, thanks for the memories, banks, but we're back with our AI obsession now. But wait, things aren't all green and dreamy. Index futures are lower this morning, and everyone's holding their breath for Friday's jobs report. Meanwhile, defense stocks are ripping, and I mean ripping, after Trump floated this monster $1.5 trillion military budget for 2027. That's trillion with a T. You know how markets get when someone throws around trillion-dollar promises, but let's zoom out. Job openings, down to 7.1 million. Private jobs in December, just plus 41,000. That's not great, folks. Basically, the labor market's like, hey, we're not collapsing, but maybe let's hit the brakes a little. And Wall Street? Still pricing in more rate cuts than the Fed's even suggested. And then there's the geopolitical chaos, because of course there is. We've got Venezuela oil tension, potential $200 billion in tariff refunds hanging on a Supreme Court ruling, and commodity flows getting yanked around by index rebalancing. So yeah, casual Tuesday. Casual. Let me cut through the noise for you, because that's what I do best. The S&P is trading around 22 times forward earnings again. Translation, it's expensive, so when bad headlines hit, they hurt. There's just not a lot of cushion left. And while the economy's cooling, it's not cracking. We're seeing softer hiring, sure, but layoffs aren't skyrocketing. So the Fed's in wait-and-see mode, and Friday's payroll number just got a whole lot more important. But here's the real story. This isn't a market up or down situation. It's narrative warfare. Let me explain. The Nasdaq's strength says people still want growth and duration. Their betting rates won't rise and AI is king. But the Dow's weakness? That's saying investors are not down for cyclical plays like financials and housing, not when policy is this messy and labor is softening. And here's the kicker. The market is underpricing policy risk. Everyone's watching earnings and macro data. But policy? It's sneaking up like a ninja. That's where the surprises come from. That's where your account suddenly goes from woo-hoo to uh-oh. All right, let's talk about who's winning, who's losing, and who's just hanging on. Winners, mega cap AI, and the whole picks and shovels crew. Demand is still there. Nvidia, still flexing. Samsung's outlook, defense contractors. You throw out a $1.5 trillion military budget? Wall Street hears revenue stream, baby. Losers, financials. Took a hit from both a downgrade and policy fears. Private equity names? Got smoked. Housing-linked names? That proposed ban on institutional buying? Yeah, the market took that as game over for the single-family rental model. And don't forget this. The bond market's telling you the Fed can cut. 2-year yield at 3.47%, 10-year at 4.15%, but the equity market is acting like it's bulletproof. All eyes on that jobs report. A hot number? Boom. Rate cut bets get nuked. So where are we now? We're in confused mode. You've got growth stocks acting like it's party time. But the rest of the market? Watching policy headlines like they're landmines. And trust me, some of them are. Volatility on the surface? Kinda chill. But we've got a calendar loaded with payrolls, Supreme Court rulings, and global central bank divergence. If you're not hedged, might be a rough week. Liquidity's still okay. 10-year yields holding steady. Curves positively sloped, which means no major stress, just slower growth being priced in. Time for the rapid-fire sector breakdown. Grab your notepad. AI and semis, bullish, but watch your six. Demand's still red hot. Samsung's riding that AI wave. Nvidia's still locking in China clients even with restrictions. But policy and execution risk are your blind spots. Defense and aerospace, bullish but volatile. Big spending headlines, yes, but the government also wants to cap buybacks and dividends. So revenue's up, but multiples might stay suppressed. Financials, bearish, getting squeezed by macro and policy. If you're in big banks or PE names, it's tough out here. Real estate and housing, bearish. Institutional ban headlines are killing the rental acquisition model. Even if the ban doesn't stick, the damage to sentiment is already done. Energy, neutral. Oil's trading on headlines, not supply-demand. Venezuela drama can swing prices fast. Stay nimble. Renewables and solar, bearish. Rate-sensitive and feeling it. First Solar got whacked on a downgrade. This space needs stable rates and hype. Right now, it has neither. Small caps versus large caps. Neutral, headline-driven. If tariffs fall, small caps could pop. If not, big caps with pricing power still win. Growth versus value. Growth leads, but fragile. Growth is in charge for now, but one bad yield spike or regulation bomb on AI, lights out. All right, let's talk next few days. What's the game plan? We're likely looking at a choppy tape with a slight growth bias heading into Friday. Bullish case, approximately 40%. Jobs data comes in softish. Yields drift down. NASDAQ keeps leading. Bearish case, approximately 35%. Surprise hot payrolls. Market yanks back rate cut hopes. Growth stocks take a punch. Wild card, approximately 25%. Supreme Court drops that tariff ruling. We get a massive sector-specific reaction. Watch for volatility. Stay nimble. Here's what you should keep an eye on today and beyond. Today, January 8th. Weekly jobless claims, trade balance, productivity, consumer credit. Yep, it's a full plate. Friday, January 9th. The jobs number, expected approximately 60,000. Could be the biggest macro mover of the week. Any day now, Supreme Court ruling on Trump-era tariffs. That decision could reshuffle sectors real fast. January 9th to 15th. Gold and other commodities feeling that index rebalancing pressure. Watch flows, not just fundamentals. Next week, big bank earnings start rolling in. JPM kicks it off January 13th. With valuations stretched, guidance will matter more than beats. All right, fam. That's the full rundown. This market? It's not up or down. It's all about the narrative battle. AI and defense are in the spotlight, but policy's the real puppet master right now. So stay sharp, stay hedged, and for the love of your portfolio, don't sleep on Friday's jobs number. Make sure to hit that like button, drop a comment on what sector you're watching, and subscribe if you haven't already, because this week's going to be spicy. I'll be back with more signals, more insights, and more whispers the market doesn't want you to hear. Catch you bright and early tomorrow. Peace out, traders.